Let me welcome Pawan Parakh on the show to talk to us about the earnings of the financial space. Pawan, the entire private banking space is seeing a complete, wash down of the numbers, if I can call it that. People are throwing in the towel. There's a very sharp cut, even for an inline set of numbers. What explains that? Because one can't say that there was a big rally in the financial names in the first case. There's no case of over ownership as well, because these stocks have always been high on the radar of FIIs as well. What then really constitutes to this kind of fall?
So, hi Anisha, thank you for having me. I think as far as financial sector is concerned, I think before the quarter, if you see people are expecting reasonably good growth and modest credit costs and maybe some contraction in NIMs. But getting into the results here, one thing that people have realized that one, the problem, the elephant in the room, which is CASA, is not a 1 or 2 quarter affair. It's perhaps a 2, 3, 4 quarter affair, which will keep earnings subdued for at least next, perhaps for the entire of this calendar year. And I think if you look in that perspective, if you look, if people are not able, private banks are not able to shore up CASA, then there's a possibility that growth may be curtailed. So it's a fine balance that banks have to trade between growth and NIMs, and that is what is actually keeping investors away. More so, not only in financial, but you see across the sector, typically when the leader gets hammered, which is HDFC Bank in this case, when the leader gets hammered, it's very difficult for another bank to do very well. You saw the similar thing happening in the IT sector also when the top four guys weren't delivering good results. Even the mid-sized IT guys were finding it very difficult to get good traction on the earnings. So I think that is the whole thing with the financial sector as well, wherein leaders are facing a difficult times, and there's a possibility that this could trickle down into smaller SFBs and other names also.
Right, Pawan. Good afternoon. This is Vinny joining in the conversation as well. Obviously, difficult times you're saying is going on for the private bank. You mentioned a whole host of reasons also in terms of the balance that is required. But anywhere specific that, you're finding value in terms of, in the banking space as a whole, would you now actually look at something like a PSU bank, or do you think there's still more value actually left in the private banking space?
I think considering the markets where they are, wherein stocks are flying all over the place, this is one sector where you can see value across the board. I don't see, if you look at the entire private banking space, I think the valuations are reasonable. I mean, look at the valuations that HDFC Bank used to trade for last 10 years. If growth was to rebound back to say about between 15 to 16% for next, say maybe 1 or 2 quarters down the line, I'm sure those valuations will come back to play. PSU banks have an advantage of a better CASA franchise, and if they are able to grow at 12-13% with an ROA of more than 1%, or maybe just light north of 1%, despite the rally, most of the banks are, I think, on forward book to value, there are between zero 0.8 to 1 time price to book. So if you look at the entire sector, be it private banks, be it PSU banks, or a lot of the NBFCs also, the valuations are fairly reasonable. I think the concerns is more on the earnings side. Maybe in one or two, or maybe 2 or 3 quarters, people will realize that the worst part of earnings is behind us, and maybe that is the time when investors will want to lap up onto these stocks.
Okay, point taken. Actually, I want your view on the auto stocks as well. But before that, let me take it across to Shrishti, because a couple of auto earnings is what is expected. TVS Motors will come out with its earnings, and so will Bajaj Auto. But Shrishti, begin by telling us what's expected of Bajaj Auto.
Well, yes, good set of numbers are expected from Bajaj Auto this time around, and the key reason being the push from the domestic motorcycle sales this time. A good push coming in from the festive season sales, and all in all, if we see, then the domestic sales has been up 22% sequentially. The good part, other than that, is also that the international sales that didn't also see any sort of a drawdown. It was almost a flattish kind of a growth that we have seen sequentially for Bajaj Auto, and overall the volumes were up 14% on a quarter-on-quarter basis, and even the realizations are expected to be high. Onto the number front, we are expecting a jump of 10.5% on a quarter-on-quarter basis. Revenue expected at 11,875 crores. EBITDA expected to show a jump of 8.5%, and the margins also expected to be above 19%, and 19.5% is the number that we are expecting this time. Lastly, onto the profit figure, a 32% jump is what we are expecting, and 1,961 crores for Bajaj Auto, and all eyes will be be on that, because EBITDA margins is expected to expand on the back of the better scales. But apart from that, we will be watching out for the company's commentary for the domestic sales outlook for this particular year, as well as the response to the new Bajaj Chetak that the company launched it recently. So all eyes will be on Bajaj Auto, though the stock has seen a good run up on the back of the festive season sales as well as the buyback announcement. So let's see how the numbers pan out this time around.
Okay, so that's about Bajaj Auto. Quickly, let me run you through the expectations from Tech Mahindra as well. The numbers are expected anytime over the course of next 1 hour. It's going to be another decline from the company. Don't be surprised by that. It's the fourth or fifth quarter that the company has been reporting a decline on constant currency basis. This time, however, it might be limited to 1% versus the 2.5% that we saw last quarter. Even in terms of margins, there is not going to be a material improvement. Remember, when we started off the year, the company was talking about an exit rate of 14% on margins. Right now, that is at a very dismal level of sub 5%. Maybe this time around, it will improve to around 5.3, 5.5 is what we're expecting, though the profitability might show a decent jump. In terms of the revenue, while high-tech, telecom, BFSI will continue to be weak, it's Comviva, which might see a bit of a ramp up, and the BPO business might also show a bit of a support. The biggest thing to watch out for is the management commentary, because this will be the first time that Mr. Joshi will be speaking as the CEO in terms of the earnings. So the entire work around that will be important in terms of what they make of the outlook going forward and the rejig that they've done in the company. But Kunal, let me toss it to you. Tech Mahindra, Tata Steel as well as DLF, all three will come out with the earnings. Any positions that you would recommend?
So I'm very bullish on the large cap IT names. I don't generally take results based trades, but I believe I think Infosys and Wipro at current levels could be a very good bet for traders. Now, of course, the stocks may dip down a bit if the results for Tech Mahindra disappoint, but those would be very marginal kind of adjustments for these stocks. I would probably look out for the trend into these stocks and looking at least another 5 to 10% kind of a swing up move over the next 1 month to 2 months for many of these IT names, large cap IT stocks particularly. I also believe Tata Steel and many of the metal stocks are now looking ripe for a breakout for themselves. I was looking at the last 1 week of price patterns as well as the data in terms of the open interest, and it's skewed towards the positive for these stocks. So hopefully with the China news also, this could propel into a breakout for many of these metal stocks which have been lying low. And even the case with DLF, I would actually believe that many of these real estate stocks are going through a bit of a profit booking wave. Once that settles in, I would believe many of these real estate stocks could be very good buying opportunities.
Right. Pawan, I'm going to come to you, and let's just talk about some of these metal names, right? Obviously, in terms of news flows, do you think anything is exciting and find value in the metal space?
No, I think it's more to do with global news flows, because as long as global prices, global news flows don't settle down, I find it difficult, why these stocks will have a big run up out here. So I think it's more about global news flow. Domestic demand continues to remain reasonably strong. Companies are adding capacity. There's a reasonably good visibility as far as volumes are concerned, in my opinion. But the problem is with the spread, because both on the cost and the pricing side, they are linked to global news flows and global things, the way they pan out. And obviously, in this entire story, China plays a very important role. So I think it's very important to track global news flows. As far as we are concerned, we are generally averse of taking bets on the commodity stocks. So metals as a space, we are generally underweight on this sector.
As far as the metal space is concerned, but let me go across to Sharad, my colleague. He's joining us to talk to us about what's the latest khabar on Dalal Street. Sharad, which is the sector of stock in focus today?
Yes, from the dealer rooms, what we are hearing is Rushi Decor is in focus and buying is seen in certain HNI counters. Now, it's expected that the revenue would touch 1,000 crore mark for FY24, and analysts are estimating that the revenue could triple to almost 3,000 crore over the next 3 years. Also, the company is shifting focus to exports as well, where they're targeting 500 crore export revenue potential over the next 3 years itself. And there is an increase in the capacity utilization on their Ahmedabad plant, especially for the exports. Apart from this, company recently also received a 3-star rating as an export house, and importantly, if you look at it, the non-retail HNI investors, they still have almost a 14% stake in the company. Looking at the stock itself, over the last 4 months, the stock has been largely flat and volatile, and there were significant corrections, but today HNI buying has picked up in this counter.
Okay, so that's about Rushi Decor and how the stock is looking like. But let me take some BTST trades as well from our chartist. Nuresh, what's the buy today, sell tomorrow idea?
So first is a buy on Dr. Reddy's, which is on verge of a major breakout. We've seen good trend across the pharma pack. This could break out in the short term. Stop loss at 58.20, target price of 6,000. Second is a buy on Container Corp, which has reversed from the same support levels of 820, 830. Stop loss at 830, target price of 860.
Kunal, what's on your BTST list?
So I'll go with one of the cash stocks. That's a buy on Tega Industries. That's a stock which is looking ripe for a breakout, a double bottom on the charts at 1120 levels. So would suggest a buy with target of 1200, stop us at 1110. And ABFRL is something which has come back into a breakout mode, a classic double bottom at play, a strong bullish engulfing pattern on the daily charts, engulfing almost last 1 week, 10 days of price activity. So would suggest a buy with a target of 255, stop us at 230.
Okay, since metals is the one where all the focus is and all the gains are, let's hope Tata Steel's numbers are okay because they're all set to report their numbers. What's the street penciling in? Let me take it across to Ashesha and find out what the ET Now poll is looking like. Ashesha?
Well, yes, for Tata Steel this time, India operations are expected to report very strong set of numbers. But as far as European operations are concerned, we are expecting EBITDA per ton loss for the 5th consecutive quarter this time. Consolidated revenues could come in at about 56,850 odd crores, up about 2% on a sequential basis, while margins too are expected to expand. They could come in at 8.5% versus 7.7% that the company had reported in the previous quarter. As I mentioned, India operations are expected to remain very strong, where realizations could inch up by about 1 to 2% on a sequential basis. EBITDA per ton could also rise by about 5%. This is on account of higher volumes and higher realizations, partially offset by higher coking coal costs in the quarter gone by. European operations over here, we are expecting EBITDA per ton loss of about $190 per ton versus $168 per ton loss that the company had reported in the previous quarter. Management commentary on European operations, especially UK, will be very crucial. Management commentary on capex and debt will also be keenly awaited.
Yes, debt as well as the UK business is something to watch out for as well as Tata Steel is concerned. In terms of the other buzzers right now, South Indian Bank is up around 14%, Mishra Dhatu Nigam is up 12%, Hudco, KEI, which is a result reaction, is also seeing quite a bit of traction. Nuresh, any individual stock that is coming up on your radar, because there has been a sizable reversal in the market itself. Has anything changed for you?
So a lot of large cap names have shown good traction. If you look at it in terms of momentum, we've seen a good recovery in Reliance Industries itself from 2600, 2650. Dr. Reddy's is close to a breakout, very close to the new 52-week highs for Dr. Reddy. One interesting observation is the fact that we saw a huge volume block happen early in the morning in HDFC Bank and made a bottom, and we've recovered from that 1380 to 1450 levels. We are seeing a similar block happen. A large 1 to 1.5 crore shares got traded at 998 for ICICI Bank, which looks like a place where from we could see a bounce back in ICICI Bank as well. So overall bias is positive. Now we watch out for 21,600, 700. If that crosses, then we get into further momentum on the Nifty.
Okay, point taken. Let me take it back to Ashesha to get a sense as to what JSW Steel expectations are. Ashesha?
Well, yes, we are expecting muted set of numbers from JSW Steel this time on a sequential basis. Lower volumes, higher cost of production and muted realization growth is why we are expecting muted set of numbers. Consolidated revenues could come in at about 42,500 odd crores, down 5% on a sequential basis, and margins too are expected to contract. They could come in at 15.6% versus 7.7% that the company had reported in the previous quarter. As far as realizations are concerned, remember steel prices were increasing till October end, after which they started falling, and hence some impact of price increase will flow through in this quarter, and hence realizations could inch higher by about 1% on a sequentially. But EBITDA per ton, that is expected to see a big knock this time of about 10 to 12% on a sequential basis, and this is on account of high cost of production and negative operating leverage. Remember, both iron ore and coking coal prices rose sequentially, and hence cost of production is expected to be on the higher side. As far as management commentary is concerned, commentary on capex, commentary on production and sales guidance for this full year and next full year will also also be crucial. But all in all, we are expecting weak set of numbers. Higher cost of production, lower volumes are expected to impact performance.
Okay, that's JSW Steel as well as Tata Steel, impending results there. But Pawan, want to specifically talk about the carnage that played out in the railway names, in the power stocks yesterday. Today, of course, some of these names, the financiers like a PFC, REC, of course, are jumping up in trade. But would you say it's getting a little frothy and they've seen a parabolic move? Maybe best to take profits here?
No, I think so. I think as far as power sector is concerned, we are into a big secular cycle now. We haven't invested into power sector for quite many years. I mean, and the sector is still plagued with a lot of issues. While the government is very clear they want to resolve a lot of these issues, but the fact is that we haven't invested much into power, and the demand is only increasing. We are almost reaching back to peak deficit levels. So from here on, I think power sector, both in terms of generation, transmission, distribution, financial, ancillary sectors, all of them, I think for the next 4 or 5 years at least, we have a very good run up in terms of earnings is concerned. If you look with that in perspective, I think as far as stocks are concerned, it's a mixed bag. Some of the stocks, like without naming any stocks, I think some of the utilities are way too expensive. I think they are pricing in more than the growth that they can potentially do. But on the other hand, if you were to look at these power financiers, REC declared their numbers yesterday. I think considering the growth outlook and considering the return ratios, and most importantly, all of this growth will come at very, very, very low credit cost, low NPS. Valuations in that sense are not so very expensive. I would not say that it's cheap and one should just lap into that stock, but it's not expensive at all. And one thing I think, not only in terms of power and railways, across the board, you would see that valuation per se is across the sector has moved up quite a bit. So in every sector which is going through a growth phase, you need to cherry pick stocks, and that's very important. And I think that's the case with power sector also. As far as railways is concerned, I think that is space which we clearly feel it's very, very, very frothy. Stocks have significantly gone ahead of the potential earnings that they can deliver, and I think across the board, the entire sector is, I think, significantly overvalued.
Railways is one space that looks significantly overvalued, but take a look at the index right now. At the highest point of the trading session, very close to that 21,500 mark. And the credit actually goes to Reliance Industries because that stock is higher by 1.5%. So that's adding almost 35 points to the Nifty weight. Look at the spike in the last few minutes. HDFC Bank is also doing its bit, almost a 2% gain coming in on that. Infosys as well, sitting with a gain of around 2%. Bharti Airtel at all-time high levels at 1190. But ICICI Bank seems to have again gone into the three-digit category. It's sub the 1,000 rupee mark right now, so seeing quite a bit of pressure. And this is despite reporting one of the best numbers from the banking space. Yesterday, the stock was high in the trading session. There was no complaints in the numbers whatsoever. A lot of the analysts increased their estimates, called it the top pick amongst the sector. But no, today nobody is buying that view. We have that decline coming in. And of course, Axis Bank, etc. are down and out in the trading session. From the frontline index itself, Kunal, what really catches your attention? And is it fair to say that the poison is out of the system now and we are likely to trend, higher rather than lower, or not a very convincing move today?
See, I think what could happen in the next couple of days, because tomorrow is expiry, is that traders would want to now juggle with their positions, because major part of the risk after yesterday's sell-off seems to be now behind. Now, what matters is that which are the sectors, which are the kind of stocks traders are bullish on, and they would want to carry forward for the next series. Of course, with budget also being one of the key events lined up. So I think that's how the positioning should be over the next couple of days. So I think what we could probably be seeing over the next maybe 1 or 2 days is more of adjustments towards portfolios rather than directions being taken or directional calls being taken out. We will have to see out the patterns in terms of the trends on open interest to try and figure out that whether we are looking at a very strong recovery for these banking names, the private sector banking stocks, or just maybe a rally after being extremely oversold in terms of indicators. So maybe 2-3 days of data I think could probably help substantiate the view. As of now, I would just look out for more of stock specific buying, wherever there is a breakout or any kind of a turnaround as such in terms of these stocks coming back from their 50-day moving averages, and stocks which have not broken below their 200-day moving averages. Those are the kind of strength stocks which I would look to trade.
Well, what about HDFC Bank, considering that was the sort of one core point which actually led to the decline in the rest of the banking pack? Is that now coming into a value buy zone? Because like you were alluding to yesterday,
earlier today that it's pretty close to its 2022 lows, right?
Yeah, it's very close to the 2022 lows. But the concern is, Aisha, that there's been an 80% jump in the open interest for HDFC Bank. So you look at the last 7 days of data, the stock was almost at 1700 rupees. From there, it fell to sub 1400. And in the last 5-7 days, there has been a 70 to 80% jump in the open interest, and this clearly indicates skew towards shorting of HDFC Bank, and that clubbed with the delivery-based data where there has been delivery-based selling into the stock price. Now, just a 30-point up move after a 300-point kind of a correction may not be a sum total analysis that these stocks have bottomed out. We would need to see a change of stance that option writers, option traders, or the F&O traders, they've changed their stance from being extreme short into these stocks and covering up their positions. If we see the data in the next couple of days, then we can probably establish a very concrete view that these stocks are bottomed out.
Okay, that's the take coming in on HDFC Bank specifically. But Pawan, Kunal, Naresh, thank all of you for taking the time out and joining us on the show.